Usually when we talk about a company trading on the stock market at an absolutely sky-high valuation, well, there is a certain expectation of what that company actually does.
Right, yeah, you expect it to be some sort of tech giant.
Exactly. If you see a stock trading like a rocket ship, you expect cutting-edge artificial intelligence, maybe revolutionary cloud software, or, some breakthrough green energy technology.
A Silicon Valley darling, basically.
Yeah, you do not expect a massive concrete warehouse that sells 50-pound tubs of mayonnaise, discounted tires, and a $1.50 hot dog combo.
It really is the ultimate market paradox. I mean, you are looking at a business fundamentally rooted in moving massive physical pallets of goods around the world using forklifts.
Right.
Yet it commands the kind of market multiple that makes high-flying tech CEOs incredibly jealous.
Welcome to today's deep dive. We are looking at a comprehensive financial research report on Costco Wholesale Corporation, updated through May of 2026.
And the numbers we are about to explore are just staggering.
They really are. As of this report, the stock has breached $1,028 per share. So our mission today is to deconstruct Costco's financial engine, explore their highly unusual approach to capital allocation, and try to answer a really difficult question.
Which is whether this retail giant actually qualifies as a deep value investment at its current valuation.
Okay, let's unpack this. Because to understand why this stock is over $1,000, we first have to realize that Costco isn't actually, in the business of selling merchandise.
No, and that framing completely changes how you analyze their balance sheet. It is the great retail illusion.
Illusion is the perfect word for it.
Look at their Q3 2026 earnings. They posted total revenue of $70.53 billion for just a 12-week period. But when you split that revenue apart, the structural asymmetry is completely wild.
So the net sales, meaning the actual physical goods people load into those massive shopping carts, make up 98.1% of that revenue.
Exactly.
The groceries, the massive televisions, the giant teddy bears, all of that is practically a break-even operation.
It is, because Costco caps its merchandise markups at an incredibly strict 14 to 15%.
Wow.
Yeah, to put that into perspective for anyone listening, traditional supermarkets mark up their goods anywhere from 25 to 50% just to keep the lights on.
That's a huge difference.
Because Costco artificially suppresses its own margins, the merchandise segment essentially just covers the cost of operating the warehouses. The real engine is membership fees.
Which make up just 1.9% of the top-line revenue, right?
Right. But that tiny sliver ends up generating roughly 75% of their total operating profit.
It's incredible. I was reading through the source material and thinking about an analogy for this. And Costco is less like a traditional grocery store and more like an incredibly exclusive nightclub.
Oh, I like that.
The merchandise on the shelves, those are just the cheap drinks at the bar. The nightclub doesn't actually care if it makes a profit on the drinks themselves.
Right. The entire business model, the real money, is the bouncer standing at the front door collecting the cover charge. What's fascinating here is the psychological brilliance of that exact dynamic. By passing all of their massive purchasing scale advantages directly back to the consumer through those capped markups, well, Costco effectively permanently secures the customer's loyalty.
Yeah, the lifetime value of a Costco member is astounding. They have over 145 million cardholders globally right now, with a 92.3% renewal rate in the US and Canada.
Which is just unheard of in retail. When a customer pays that cover charge, they are so determined to get their money's worth that they consolidate their shopping habits.
Right, they buy everything there.
Exactly. That turns the membership fee into basically a guaranteed annuity.
And with the compounding effect of the fee increase they implemented in September 2024, that annuity is producing an avalanche of cash. But even if you make your profit at the door, managing the nightclub still comes with massive overhead.
Oh, absolutely.
I mean, Costco has to physically stock 914 warehouses globally. Think about the logistics of purchasing billions of dollars of inventory. That costs an absolute fortune.
It does. Yet they pull off this financial magic trick where they basically get their own suppliers to fund their global expansion.
So how does that work?
This introduces the concept of a negative working capital cycle. To understand how they achieve it, we have to look at their inventory strategy. A typical supermarket carries over 100,000 distinct items or SKUs on its shelves.
Okay.
Costco only carries about 4,000.
That hyper-consolidation is wild. You don't get 20 choices of ketchup. You get one, maybe two. And often, it's their own private label, Kirkland Signature.
Kirkland Signature is a behemoth of a brand. It just celebrated its 30th anniversary, and it pulls in $90 billion annually all by itself.
Wow.
That is roughly 33% of their total sales. And the mechanics behind it are brilliant because Costco channels such immense concentrated volume through so few items. They hold unprecedented, overwhelming bargaining power over their suppliers.
So the suppliers really need them.
Desperately. If a supplier wants access to Costco's 145 million premium shoppers, they have to play by Costco's rules, and that bargaining power allows Costco to dictate extremely favorable payment terms.
So this is where standard financial metrics start flashing red for traditional analysts. The Deep Value Report points out that Costco's current ratio is 1.06.
Right.
For anyone listening who might be newer to reading balance sheets, the current ratio compares a company's liquid assets to its short-term liabilities. It basically tells you if a company can cover its immediate debts.
And usually a ratio that close to 1.0 means a company is dangerously close to a liquidity crisis, right? Like
Right.
barely able to pay its bills.
Exactly.
In a standard automated deep value screener, 1.06 would absolutely flag as severe liquidity pressure. But we have to reframe this for Costco's specific operational model.
Okay.
For them, a low current ratio is not a weakness. It is arguably their greatest superpower. Costco turns its inventory over 12.5 times a year.
Wow, that fast.
Yeah, that means they take a pallet of goods, put it on the floor, and sell it to the customer, collecting cash immediately. But their negotiated terms with the supplier might dictate that Costco doesn't actually have to pay for those goods for 30 or 60 days.
Oh, I see.
They sell the product, collect the cash, and earn interest on it before the bill is even due.
Wait, I want to push back on this because it sounds almost too good to be true. You're telling me suppliers are basically giving Costco an ongoing, massive, interest-free loan to fund their own corporate expansion.
Essentially, yes.
But what happens if consumer traffic suddenly slows down? Let's say there's a severe recession, foot traffic drops, the inventory sits on the shelves, and the cash doesn't come in.
Right.
Those 30-day supplier bills are still coming due. Does this whole negative working capital treadmill suddenly fly off the tracks?
That systemic risk is exactly what analysts monitor. If inventory turnover slows dramatically, a negative working capital cycle can instantly become a liquidity trap.
So how do they avoid that trap?
The buffer against that catastrophic scenario is their astonishingly stable cash flow. Over the trailing 12 months leading up to May 2026, Costco generated $9.10 billion in free cash flow.
That is a massive safety net.
It is an immense cash cushion, combined with the fact that their inventory leans heavily toward essential goods, food, paper products, pharmacy items, stuff that performs well even in deep economic downturns. That mitigates the treadmill risk.
Still, no business is completely immune to macroeconomic gravity, and the report highlights some real headwinds. Wage inflation is a major one.
It is a significant pressure point on their margins. Costco has a long-standing commitment to leading the retail sector in employee compensation.
Right.
In fiscal 2025, their average hourly wage in the U.S. reached $32, or roughly $46 an hour when you factor in healthcare and their comprehensive benefits packages.
Which puts constant upward pressure on their fixed to semi-variable costs.
Exactly. And beyond labor, you have global import tariffs disrupting supply chains and increasing activist shareholder pressure regarding Scope 3 emissions.
Which is a massive logistical nightmare. I mean, it's one thing to make a corporate tech office carbon neutral. It's another entirely to police the carbon footprint of thousands of global beef and agriculture suppliers.
Oh, totally. A landmark proposal previously secured nearly 70% shareholder approval, demanding science-based greenhouse gas reduction targets across Costco's entire value chain.
Wow.
Yeah, transitioning massive agricultural networks to carbon-neutral standards could permanently elevate production costs, threatening that strict 14 to 15% margin cap we discussed earlier.
Yeah. Managing razor-thin margins, mitigating supply chain bottlenecks, and navigating complex labor dynamics, that isn't something you can just run through a software program.
Yeah, not at all.
It requires ruthless, experienced human discipline. So let's look at the people actually pulling the levers and how they reward the shareholders who own the company.
Well, corporate governance at Costco actively rejects a lot of standard Wall Street practices. Take the CEO, Ron Vakris, who stepped into the role in January 2024.
Okay.
He didn't parachute in from an Ivy League consulting firm with a playbook of theoretical efficiencies. He started at Costco 40 years ago as a literal forklift driver.
A forklift driver to CEO. You really don't see that often anymore.
You really don't.
And there is a practical bottom line benefit to that, right? Because he knows exactly how warehouse operations work on a granular level. Management isn't wasting money on out-of-touch corporate mandates that look good on a spreadsheet but fail on the warehouse floor.
Precisely. And their compensation structure reflects that internal culture. Management-based salaries are kept intentionally modest compared to S&P 500 averages.
Interesting. So how do they make their money?
Instead of huge cash salaries, executive wealth is tied up in performance-based restricted stock units, or RSUs.
Which makes perfect sense. Cash bonuses incentivize executives to cut corners this year just to hit an arbitrary quarterly target. RSUs force them to care deeply about what the stock is going to be worth 5 years from now.
Yeah.
And that long-term view really shows up in how they return cash to shareholders.
It absolutely does.
Because this is where I got a little tripped up reading the source material. Most massive corporations today return cash by constantly buying back their own stock to artificially inflate their earnings per share.
Yep, it's standard practice.
But Costco refuses to play that game. Their buyback yield averages a super low 0.3 to 0.4% over the last decade.
Yeah.
Instead, they hoard cash and then drop these massive, seemingly random special dividends. $5 a share in 2015, $7 in 2017, $10 in 2020, and a massive $15 a share in January 2024.
Right.
So what does this all mean? Like, why use special dividends instead of just buying back stock like everybody else?
I keep thinking about an analogy. Buying back an overvalued stock is essentially like paying $1,000 for a $500 bill, just so you can say you have fewer bills in your wallet. That analogy hits the nail on the head. It comes down to a ruthless discipline regarding capital allocation.
Okay.
Management understands that heavily buying their own stock when the price-to-earnings multiple is vastly inflated actually destroys capital value.
Right. You're overpaying for your own business.
Exactly. If the stock is trading at 50 times earnings, every dollar spent on a buyback is an inefficient use of shareholder funds. So instead, when their cash reserves exceed their internal reinvestment opportunities, like opening new warehouses or upgrading global logistics, they simply hand the raw cash directly back to the owners.
Even though it makes their balance sheet look objectively worse in the short term.
Yeah, the report explicitly notes that Costco's book value per share actually contracted in 2017 and again in 2024.
And a standard algorithmic screener might flag that as a company losing fundamental value, right?
It would, but those contractions happened solely because they distributed billions in those special cash dividends. They artificially shrank their book value on paper, but they maximize true realized shareholder returns.
So it is proof of management prioritizing economic reality over financial optics.
100%.
Which perfectly sets up the great debate among the value investing legends. The research details how Warren Buffett's Berkshire Hathaway held Costco for over 2 decades, but completely liquidated their 4.3 million shares in late 2020 when the price was hovering around $300 to $330.
Yeah, Buffett bailed because the valuation got too rich.
But his late partner, Charlie Munger, personally held onto his shares until his death, famously calling Costco one of the finest compounding machines he had ever seen.
And this highlights the most crucial evolution in modern value investing. Early in his career, Buffett was famous for cigar butt investing.
Right, finding mediocre companies trading at dirt cheap prices, taking one last puff of profit and discarding them.
Exactly. But Munger fundamentally shifted Buffett's philosophy toward buying incredible, high-quality businesses at fair prices. And Costco is the ultimate embodiment of Munger's philosophy.
So if you were to look at Costco stock today, in mid-2026 at over $1,028 a share, what are you actually buying? Let's run this company through the deep value gauntlet.
Well, if we run Costco through the traditional Ben Graham deep value checklist, it fails spectacularly on almost every single metric.
Not a huge surprise there.
A deep value investor generally wants a price-to-earnings ratio under 15. Costco's is 53.7.
Wow.
They want a price-to-book ratio under 1.5. Costco's is 15.1. They want a Peter Lynch PEG ratio under 1, and Costco's is 5.0.
Let's pause on that PEG ratio for a second, because it's a vital concept for our listeners. The PEG ratio, price earnings to growth, basically measures how much you are paying for the company's future growth.
Right.
A PEG of 1 means you are paying a perfectly fair price for the growth you expect to get.
Yeah.
A PEG of 5.0 is wild. It means investors are paying an enormous, almost unprecedented premium for whatever future growth Costco can muster.
Right. By standard asset bargain metrics, it is undeniably overvalued.
Okay, but
then you evaluate it against the Charlie Munger test, which prioritizes operational excellence over cheap multiples, and Costco passes the Munger test flawlessly.
how so?
Their return on invested capital, or ROIC, is a stellar 22.2%.
Meaning, for every dollar of capital invested into the business, Costco generates over 22 cents in profit every single year. which is incredibly efficient for a physical retailer.
Absolutely. Additionally, their return on equity has averaged 25.8% over 10 years. Their earnings per share growth is perfectly consistent with zero contraction years over the last decade.
So to really isolate what the company is actually worth today, the research report built a multi-scenario discounted cash flow, or DCF model.
Yeah.
For our listeners, a DCF model basically tries to calculate the present-day value of all the cash a company will ever generate in its future. It requires making assumptions about how fast the company will grow.
Right, and the report's nominal historical growth case assumes Costco just keeps doing exactly what it has been doing, growing free cash flow at an impressive 15% for the next 10 years,
And that model spits out an intrinsic value of $973 per share.
which is a very sobering number given the current trading price.
Extremely sobering. Because even if Costco performs amazingly well, perfectly executing their historical average for the next decade, at $1,028 today, the stock is still technically overvalued.
Yeah.
To actually justify the current price and build in a standard 30% margin of safety, the model requires you to believe in the optimistic scenario.
And that scenario assumes Costco can accelerate and sustain an 18.22% growth rate for a straight decade.
We are talking about a mature, massive, global enterprise sustaining startup-level growth for 10 years.
It's a tall order.
Here's where it gets really interesting. Costco is arguably a perfect business, but perfection is already entirely priced into the stock.
Yeah.
You weren't just betting on Costco being good, you're betting on them never, ever making a single strategic mistake.
What's fascinating here is, well, if we connect this to the bigger picture, it explains why major institutional value managers hold the stock, but are very hesitant to actively buy more at these levels.
Yeah, that makes sense.
Costco is structurally overvalued for a reason. Because of the sticky membership model we discussed at the start, their cash flow has incredibly low volatility.
Almost like a bond.
Exactly. It behaves almost more like a high-yield treasury bond than a traditional retail equity. The broader market applies a massive premium to that safety and stability.
Right.
So the final verdict of the source material is deeply nuanced. Costco is a hold forever core asset for existing investors who bought in at lower valuations. But for new money looking to initiate a position today, the complete lack of any margin of safety makes it potentially dangerous at these multiples.
It's the ultimate test of investing discipline. I mean, you can love walking the aisles, you can love the incredible value of the hot dogs, but as an investor, you have to respect the math of the valuation.
You really do.
Now, before we wrap up today, I want to leave you with a final thought to ponder. Based on fascinating detail tucked away in the geographic breakdown of their footprint, Costco currently operates over 600 warehouses in the United States alone. Long-term domestic saturation is a very real looming threat. To justify this $1,000 stock price and keep that 15 to 18% growth engine running, the future absolutely requires massive international expansion.
Right. They have 40 stores in Mexico, 33 in Japan, 29 in the UK.
But they need hundreds more globally to move the needle. So think about this. Costco was built on a deeply ingrained, employee-first, forklift-to-CEO American corporate culture.
Right.
Can that incredibly specific cultural magic successfully translate across dozens of completely different global labor markets? It's one thing to export massive pallets of cheap mayonnaise. It's entirely another challenge to export a corporate soul.
That is a brilliant point.
Before we sign off, I have a quick note to share with you all. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics including life's and investing philosophy, please subscribe to our sister channel Deep Values. Don't forget to like this video. Much appreciated.
Analyzing a company like this really emphasizes that whether you are looking at a tech startup or a bulk retailer, the fundamental mechanics of cash flow and capital allocation always dictate the long-term reality.
They always do. You know, at the start of this deep dive, we talked about how Costco doesn't look anything like a Silicon Valley tech darling. But maybe that's exactly why the model is so resilient.
Yeah.
When the digital algorithms fail and the software trends inevitably fade, there is an enduring, unbreakable value in standing at the door of the nightclub, quietly collecting the cover charge while everyone else fights over the price of the drinks. Thanks for joining us, and we'll see you on the next deep dive.